The Fed will lie about inflation. Inflation will only get higher from here, especially by lowering the front end. And the market understands this. Gold understands this. This is why gold is roaring. This is why the bond market is selling off and rates are going higher. And of course, you can talk about the weaponization of the Treasury market, which only adds fuel to that fire. But this is something that I would expect to see continue. You cannot expect to lower rates, go back to an inflationary policy, especially with asset prices at all-time highs, and not expect there to be consequences on the back end of the curve, where holding at these rates for any duration when inflation will erode and eat away at the purchasing power is insanity.
So, after many months of speculation, the Federal Reserve Board of Governors announced its decision on September 18th to cut the benchmark interest rate, the first rate cut since March 2020. The Federal Open Market Committee, FOMC, opted for a significant 50 basis point reduction, lowering the federal funds rate from 4.75% to 5%. This move indicates growing confidence that the annual inflation rate is trending downward toward the Fed's target of 2%. The FOMC's statement noted, "Recent indicators suggest that economic activity has continued to expand steadily. Job gains have slowed, and the unemployment rate has increased but remains low. Inflation has progressed toward the committee's 2% objective but remains somewhat elevated." The committee expressed increased confidence that inflation is sustainably declining and that the risks associated with its employment and inflation goals are balanced. In a recent interview, Andy Schectman, CEO and president of Miles Franklin, raises significant concerns about the transparency of official inflation statistics, highlighting how this lack of clarity contributes to apprehensions regarding the true risks inflation poses to investments. As confidence in traditional investments declines, investors observe rising bond yields, prompting a notable shift toward alternative assets like gold, which are often viewed as more stable during periods of economic uncertainty. Gold's recent ascent to $2,800 an ounce, a remarkable 35% increase this year, underscores this changing sentiment. Analysts suggest that despite its impressive run, the market still holds substantial upside potential. Schectman emphasizes that high levels of leveraged debt and sensitivity to interest rate fluctuations mean that even minor rate increases can strain the economy's capacity to manage its obligations. If debt levels become unmanageable, this situation poses the risk of broader financial instability, revealing underlying vulnerabilities within the U.S. economy. As these dynamics shift, many investors are realigning their perspectives, moving away from bonds and traditional securities in favor of gold, which offers perceived resilience in volatile economic conditions. Now, we present the clips of Andy Schectman's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Well, I think there's a global need for a reliable store of value done again, and this is to facilitate trade and to safeguard excess capital. And I think the key is also without counterparty risk. I don't think the bonds can longer fully provide either. You see the Fed lower rates, as we've talked about. There's all this talk of signaling victory over inflation, but it's not. They were 60+% away from their target at 2%. What it is raising the white flag. What it is massaging and manipulating the numbers that comprise the CPI out of the Bureau of Labor Statistics. And whether it be about unemployment or about inflation, the numbers that come out of there are suspect, to say the least. And what we are seeing, really, as far as I'm concerned, is the market's way of saying, at this point, buying any duration treasury. This is me talking. Let me just say this, that anyone who would buy any duration treasury, 10-year or longer, to me is crazy. I think they're uninvestable. The Fed will lie about inflation. Inflation will only get higher from here, especially by lowering the front end. And the market understands this. Gold understands this. This is why gold is roaring. This is why the bond market is selling off and rates are going higher. And of course, you can talk about the weaponization of the Treasury market, which only adds fuel to that fire. But this is something that I would expect to see continue. You cannot expect to lower rates, go back to an inflationary policy, especially with asset prices at all-time highs, and not expect there to be consequences on the back end of the curve where holding at these rates for any duration when inflation will erode and eat away at the purchasing power is insanity. And so I think that's the market saying just that. The concept of holding debt as an asset, I don't think is something that has a massive historical footprint. When you over lever the debt the way that we have, and this debt that's very interest rate sensitive, and then rates start to go higher and the economy starts to slow, the maintaining of debt becomes very big deal. And if the debt isn't able to be serviced, and this is the whole concept of credit default swaps, where if you're trading with another partner who you don't quite trust, you take out an insurance policy against them and their ability to pay. And the insurance company's like, well, that's big money. Let's do it. Let's do it. And then boom, it blows up. And then real quick, the whole thing starts to spin out of control. So it's a problem. It's a problem that has to be dealt with. And this debt problem can't really be paid back. So the ironic thing about it is that most of it is owed to the American people, Medicare, Medicaid, Social Security, the government, military pensions. And so much of the money that's gone into treasuries has, as the foreigners have been selling them, we've been buying them chasing yield. So if you really want to get into the weeds and talk about resetting the system, we're resetting predominantly upon the American people. Only about 7 trillion is owed. That's a lot to the rest of the world, but to the American people, it's the majority. And what I was looking for earlier, by the way, Bank of America survey showed that 71% of financial advisors had a 0 to 1% allocation to gold. This was at the end of 2023. While only 27% had a 1 to 5% exposure, shockingly, just 2% of advisors reported a 5 to 10% allocation. And, we're nowhere near the top in this bull market, as the American participation in the face of, positive real yields, if you believe the BLS and the BLS and the CPI, positive real yield, strong dollar, no American participation, nothing in terms of institutional money, and it still goes higher. And that's because of the central banks. They're the most well-informed traders in the world, and Wall Street will catch on.
Recent headlines have raised alarms about the risk of bail-ins under the Dodd-Frank Act, which allows banks to convert their debts into equity during financial crises rather than relying on government bailouts. Andy is concerned that this could mean depositors might absorb losses, leading to panic and mass withdrawals that could destabilize the banking system. The recent acquisition of Credit Suisse by UBS has further fueled these worries, as the interconnectedness of banks means that issues in one institution can quickly ripple through the entire sector. Additionally, many banks are not meeting the Basel III reserve requirements, which heightens systemic risks. With over 60 banks currently flagged as troubled by the FDIC and possibly more at risk, keeping large deposits in these institutions has become increasingly precarious. Andy points out that if the Federal Reserve chooses not to step this time, the situation could worsen quickly. Historically, the Fed has played a critical role in stabilizing the economy by providing necessary funds during crises. A decision not to intervene now could raise serious questions about the future of the US dollar and how the global community perceives US treasuries amid ongoing inflation.
The Basel III regulations said that the banks had to maintain a 4.5% reserve ratio. It's been zero for quite some time. So when you think about it, you aren't depositing money in this bank. You're giving them an unsecured loan that they're buying assets with. It's gone. They only have to keep 4.5 cents on the dollar in the bank, and so they're making loans. and after the crisis that we saw with the treasuries, and now we see an environment where, okay, maybe they're buying 10-year treasuries again, thinking, okay, we everything's okay. Rates are higher and it's maybe safe to buy it. And then what do they try to do? They try to lower the front end of the curve, and the back end goes up, putting the bank's balance sheet in worse position again. These are problems that will not go away. These are problems that are, I think, systemic to the system. They won't go away. And part of me feels as though that's the intention here. I mean, you ask yourself, why would the Federal Reserve, in essence, goat all of the banks into loading up on treasuries and fueling the narrative of low interest rates forever, only to then raise them by 500 basis points, the fastest raise ever in the period of a year, creating these problems? It's absolutely insanity. But I do think that, the FDIC or the troubled bank list, so there's over 60 plus banks. There's probably a whole lot more than that are in real trouble. And I don't think the First National Bank of Lindsay was on that list. So anyways, yeah, I would just simply say the banks are not in good shape. If you have money in any bank account above the FDIC limit, I think it's insanity. And we were told this by Powell. There would be consolidations. This is what they want. They don't want 5,000 banks. They want a much smaller network of banks as we transition into central bank digital currencies, making it much easier to roll out modern monetary theory if we really go down that path. But this is just beginning, done again. If the Fed doesn't come in like they have before, everyone says, well, if you just would have left your money in the stock market after '08, and you would have been made whole. Yeah, well, the Fed added $9 trillion into the kitty to support, the bond market, to depress interest rates, to support the stock market, the real estate market. It's all artificial. It was all propped up by a Fed who came to the rescue. What would the world look like had they not done that? And I think that's what you need to ask yourself. And the question is, will they come to the rescue again this time? And if they do, what does the rest of the world think about holding our treasuries of any duration and our currency that is being inflated away? That's the question that has to be asked. So, you get to a point where you're so far in debt, you need, like, let me phrase it this way. We had the second biggest trade deficit in history last month, like 108 billion or something. Well, if that doesn't tell you how important it is for this country to be the world reserve currency, and how reliant we are on the rest of the world for imports, because we are reliant upon these people taking our dollar for their goods, and we are very reliant upon buying their goods because we've offshored so much of our production and manufacturing, and it's not sustainable. You end up compromising the world's desire to hold your currency and to hold your treasuries. That's when things start to really snowball. Now, we're not there yet, obviously, but these are the kind of actions that lead to an acceleration, lead to that moment where the world says, yeah, I don't want any more dollars, or I don't want your treasuries. And this is the rise of the BRICS and trading in local currencies, and why gold is doing what it's doing. So it's all one big dirty mess, but it's all connected together.
The Federal Reserve's decisions on interest rates will play a crucial role in shaping gold's performance after the 2024 election. The Federal Open Market Committee, FOMC, will meet on November 6th and 7th, just one day after the election, and any rate decisions made during this meeting will likely have an immediate impact on the gold market. Historically, gold tends to rise when interest rates are lower, as reduced yields on other assets will make gold more attractive. In 2024, despite elevated interest rates, gold is expected to reach record highs, driven by anticipations of future rate cuts. If the Fed announces a post-election rate cut, it will likely provide further support for gold prices. Please share your thoughts on Andy's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.